Ladies and gentlemen, good day and welcome to Axis Bank conference call to discuss the bank's financial results for the quarter and half year ended September 30th, 2023. Participation in this conference call is by invitation only. Axis Bank reserves the right to block access to any person to whom an invitation has not been sent. Unauthorized dissemination of the contents or the proceedings of the call is strictly prohibited, and prior explicit permission and written approval of Axis Bank is imperative. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. On behalf of Axis Bank, I once again welcome all the participants to the conference call. On the call, we have Mr. Amitabh Chaudhry, MD and CEO, Mr. Rajiv Anand, Deputy Managing Director, and Mr. Puneet Sharma, CFO. I now hand the conference over to Mr. Amitabh Chaudhry, MD and CEO. Thank you, and over to you, sir.
Thank you, Nirav. Good evening and welcome everyone. In Q2 financial year 24, we continued with the focus on GPS metrics that we had set for ourselves a couple of years back. The P&L performance and balance sheet quality of the bank is now significantly different from the past, which gives us confidence in sustaining it across cycles. Let me briefly explain these structural changes. The current level of 18% plus ROE is delivered at a much lower risk-weighted asset intensity than in the past. This has helped the bank become self-sufficient on capital. The bank accreted 18 basis points of CET1 capital in Q2 financial year 24 and 54 basis points in the first half of financial year 24, with CET1 levels now at 14.56%. On profitability, there is visible improvement in quality and consistency of the bank's earnings. In Q2, the bank delivered amongst the best core operating profit growth, driven by one of the best margin and fee performance among large private banks. On loan growth, all the three segments have grown above 20%, with SME book growing 9% quarter on quarter. On deposit quality, we have improved meaningfully with one of the best LCR outflow rates and CASA ratio in the sector today. On digital and tech, our people, product, APIs, and system architecture continue to be among the best in class. It is validated by so many successful partnerships across the bank and its new product launches, which I'll share later during this call. These structural improvements provide us the flexibility to build a bank for the future with the investment in our chosen areas of distinctiveness, namely digital, Bharat banking, and customer obsession, while working on synergies from acquired city businesses. We continue to remain focused on three core areas of execution of our GPS strategy, namely embedding a performance-driven culture, strengthening the core, and building for the future. I will now discuss each one of these areas. On embedding a performance-driven culture, there is visible improvement in the retail deposit growth and the quality of our deposit franchise. We have made solid progress in improving the quality, granularity, and premiumization of our deposit franchise through multiple bank-wide transformational initiatives. The result of these already reflect in our improving retail deposit performance. The growth trajectory of retail term deposits continue to improve, with 15% year-on-year and 4% quarter-on-quarter growth on period-end basis, and 13% year-on-year and 4% quarter-on-quarter growth on QAB basis. Low-cost CASA shares stood at 44.4%, among the best in the industry, and compounding at 15% for the last 3 years. In the last 2 years, the bank's outflow rates on Basel reporting basis have seen reduction by 550 basis points and are now trending closer to the best in the Indian banking sector. During the quarter, we achieved a milestone of opening the 5,000th branch and added 207 branches and 110 new centers to widen our distribution network to 5,152 domestic branches. A second was all-round growth across businesses. We have shown a market-leading growth in our focus segments. Within retail lending, we continue to drive balance growth across the product portfolio. The retail disbursements in the second quarter financial year 24 were the highest ever for a non-financial year end closing quarter. Corporate loans grew 21% year-on-year and 3% quarter-on-quarter, led by a healthy pickup across sectors. The disbursement pipeline for Q3 continues to be healthy. MSME segment continues to remain a key growth driver for the bank. The combined portfolio of mid-corporate SMEs and small businesses grew 33% year-on-year and 9% quarter-on-quarter, and now constitutes 21% of the loan book, up over 680 basis points in last 3 years. As far as strengthening the core is concerned, on wholesale banking, we have strengthened our capabilities in the transaction banking and treasury segments in the last 2 years. Our API-led transaction banking new proposition offers strong product market fit and continues to witness strong adoption. The interest among corporates continues to grow at an accelerating rate, with 2.3 times customers onboarded in September over last year. Similarly, transaction volumes and throughput have surged by 5 times. Additionally, Neo for Business, which is our mobile-first banking and beyond banking MSME proposition designed specially for SMEs, went live in the current quarter. We have about 5,000 businesses being onboarded every month with strong adoption rates. The offering has many standout features when compared to market offerings by banks and fintechs. Please refer to slide 40 of our investor presentation for more details. Last, building for the future, our digital banking performance continues to remain strong. We have rebranded our award-winning mobile app as Open by Axis Bank. Its balance sheet continues to deliver strong growth with over 50% increase in deposits and loans. Open is now roughly 5% of the bank's overall business, and we intend to increase the contribution by 3 to 4 times by fiscal 2027. As part of the Open by Axis Bank launch, we have introduced several changes to our mobile banking app and internet banking portal. In addition to branding changes, these include a revamped landing page, hyper-personalized nudges, personal finance management, vernacular language for internet banking, etc. Our app continues to remain the highest-rated mobile banking app on Google Play Store, with a rating of 4.8 based on over 2.2 million reviews. Continuing our aspirations to be leader in new platform businesses, we launched credit on UPI on pilot basis working with NPCI. We aim to launch this for customer usage in the coming quarter. Further, Axis Bank was one of the first banks to integrate with the public tech platform for frictionless credit, launched by the RBI and RBI Innovation Hub. The bank offers MSME loans in under 5 minutes, leveraging this platform. We continue on our programs to build distinctiveness. Our big bet on Bharat is growing from strength to strength. In rural advances, the balance sheet added in the last 24 months is 2 times the size of the balance sheet added in the previous 4 years. Our distribution footprint has increased to 2373 Bharat banking branches, complemented by 63,000 strong CSC VLE network. We have scaled up marquee names such as IDC, Bayer, and Airtel Payments Bank, demonstrating progress in success of partnership and value chain approach. Our digital co-lending platform is live with 8+ partners, and we have more products and partners lined up to go live on the platform this year. Sparsh, our customer obsession program, is making an impact on our customer experience scores. We believe that only a deeply embedded culture of customer obsession can help us sustain this journey. Earlier this month, we celebrated Sparsh Week, a pan-bank event with a focus to listen to our customers, act on it, and celebrate. Over the last 18 months, NPS across retail customer journeys has moved up to 148 over an index baseline of 100. On Citibank consumer business integration, the employees of the customer integration so far is on track. We are also witnessing synergy benefits coming through with improvement in productivity and best practices transfer across the organization. One of the key strengths of Citi was the customer service capabilities. The erstwhile leadership team of Citiphone is leading the upgrade of our service architecture in line with the best-in-class standards. In closing, in spite of the highly volatile global geopolitical landscape, we believe the Indian story remains strong and intact. With the upcoming festivities, we are already seeing our surge in demand, which occurs well for business. At Axis Bank, our GPS agenda is on track, and we're looking at steady growth for all major business verticals of the bank. I will now request Puneet, our CFO, to take over.
Thank you, Amitabh. Good evening, everyone, and thank you for taking the time to join us this evening. Our H1FY24 PAT was 11,661 crores, growing 23% YOY. Our H1 consolidated ROE was at 19.04%, up 179 basis points YOY. The PAT and ROE were driven by NIMs at 4.11, 30% YOY growth in H1 fees, 23% YOY loan growth, aided by 15% YOY retail term deposit growth. Our Q2 FY24 PAT was 5,864 crores and our consolidated Q2 ROE was 18.67%. Our operating performance has been healthy. Net interest income grew 19% YOY, 3% quarter on quarter. Net interest margin at 4.11%, up 15 basis points YOY, 1 basis points quarter on quarter. Fee income grew 31% YOY and 11% QOQ. Retail fee grew 38% YOY, 11% Q on Q. Granular fees is at 93% of our total fee. Core operating revenues grew 22% YOY and 6% sequentially. Core operating profit grew 12% YOY and 5% sequentially. Consolidated ROA and ROE were 18.67% and 1.83%. Subsidiaries contributed 37 basis points to ROE and 7 basis points to ROA. Strong loan growth delivered across all of our business segments. Our domestic advances were up 26% YOY, 5% sequentially. Our retail loans were up 23% YOY, 4% sequentially. SME loans were up 27% YOY, 9% sequentially. Our corporate loans were up 21% YOY, 3% sequentially. Rural loans grew 24% YOY and 4% sequentially. Our small business banking loans grew 42% YOY and 9% sequentially. Our mid-corporate loan book grew 37% YOY. Our small business banking plus SME plus mid-corporate book stands at a cumulative value of 1,88,573 crores, 21% of cumulative loans. This is higher by 680 basis points over the last 3 years. Important to note that this is a high yield, high profit book. Retail term deposits have started gaining traction with steady growth in granular deposits. On a month-end balance basis, retail term deposits grew 15% year-on-year and 4% quarter-on-quarter. Our CASA ratio stood at 44%. Total deposits grew 18% YOY, 1% sequentially. On a quarterly average balance basis, our total deposits grew 16% YOY, 1% sequentially. Retail term deposits performed meaningfully better with a 4% sequential growth. Our QAB SA balances grew by 17% YOY, 1% quarter-on-quarter, and CA grew at 11% YOY. Our quarterly average balance CASA ratio stood at 43%. Average LCR for Q2 FY24 was 118%. Outflow rates improved by 550 basis points over the last 2 years. We are well capitalized with a self-sustaining capital structure, adequate liquidity buffers. Our overall capital adequacy ratio is 17.84% with a CET1 of 14.56%. Amitabh indicated that we have a self-sustaining capital structure. We have had a net accretion on CET1 of 54 basis points for H1 FY24 and 18 basis points for Q2 FY24. Important to note, COVID provisions of 5,012 crores not included in the CAR computation discussed above provides us with an additional cushion of 48 basis points on the capital adequacy ratio. We continue to retain a strong position in payments and digital banking. We've issued 1.2 million cards in Q2 FY24. Cards in force market share is at 14.1% as of September. Our spends are up 60% YOY and 5% Q on Q. We are the second largest player in merchant acquiring with a market share of 18.6%, incremental market share of 23% in the last 1 year. Axis Mobile and Axis Pay have 9.2 million non-Axis Bank customers using these facilities. 100 plus digital partnerships across platforms and ecosystems, 16.5 million customers on WhatsApp banking. Axis Mobile remains the world's highest mobile banking app on the Google Play Store with a rating of 4.8 and 13 million monthly active users. Our asset quality has improved. Declining gross NPAs and slippages for the quarter are visible. The GNPA at 1.73% declined 77 basis points YOY, 23 basis points Q on Q. Net NPA at 0.36% declined 15 basis points YOY and 5 basis points Q on Q. Our PCR remains healthy at 79%. On an aggregate basis, all provisions, which is specific, standard, additional, and COVID, divided by gross NPA, gives us a coverage ratio of 150%. Q2 FY24 gross slippages on an annualized basis is 1.49%, declined 39 basis points YOY. Net slippage ratio annualized was at 0.59%. Q2 FY24 credit cost annualized is at 0.42%, declined 8 basis points on a sequential quarter basis. Our domestic subsidiaries continue to deliver steady performance. H1 FY24 profit for the domestic subsidiaries is 689 crores, up 18% YOY, with a return on investment on domestic subsidiaries at 53%. Axis Finance H1 FY24 PAT grew 26% YOY to 265 crores. Asset quality improved and capital adequacy ratio was at 17.9%. Axis AMC H1 FY24 PAT stood at 189 crores. Axis Securities H124 PAT grew 14% YOY to 113 crores. Axis Capital executed 48 investment banking deals in the first half of FY24. With this, we conclude our opening comments. We'd be very happy to take questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Ankur Mishra from ET Now. Please go ahead.
Hi, good evening, everyone. Congratulations on the earnings. My question is regarding your corporate growth, which is showing 21% YOY and 3% QOQ growth. I want to understand that the domestic book growth of over 30%, is it this quarter per se growth, or it is going to sustain? Because we have seen that mid-corporate was growing at that pace even more than this. But how do you see the corporate sector growth in particularly this quarter?
Thank you for the question. Let me just offer a data point clarity, and then I'll request Rajiv to provide the outlook on corporate loan growth for the quarter. Just out of abundant caution and clarity on the numbers, what we stated was the corporate book was up 21% YOY, 3% sequential quarter. That is the total corporate book. If I were to make an assessment only of the domestic loan book, our domestic corporate loan book was up 33% YOY and 4% sequentially. What that indicates is that we've run down our foreign currency corporate book. The domestic corporate book has gained traction. With that data point clarification, I hand over to Rajiv for.
As Puneet just mentioned, domestic demand continues to be strong, and it continues to be strong across sectors, both on the working capital side and on term loans. And as I've been mentioning earlier as well, we certainly see demand for capex from the private sector.
Okay. Another question on your home loans, which compared to other sectors, it is growing at 9% in single digit. What has been reason for that? And if I can squeeze in one more question regarding your personal loan and credit card advances, which is 72% YOY. Do you see that these numbers will continue? Why I'm asking is because the RBI has also been nudging banks to be cautious in this sector's growth.
Hi Ankur, this is Sumit here. So on the home loan, I'll start with that. So last 2 quarters, you would have observed we were focused more on correcting the NIM journey. Subsequent to that, we have seen recovery in the home loan volumes. This volume has grown vis-a-vis Q1. The growth rate is looking up, and we expect that we will continue to increase the growth rate as we go quarter on quarter. Regarding the personal loan side, we have been running a strategic project internally. We continue to focus on our ETB customers. We continue to focus on our partnership customers. So those have been good sourcing engines for us. My sense is this kind of growth will sustain, and it is not coming at the cost of credit quality. Our risk appetite remains in line, and that's how we are looking at sourcing. There's no dilution in our standards. For credit card, I'll hand over to my colleague Arjun.
Yeah, thanks, Sumit. Hi, Ankur. So on the credit cards piece, the 72% does include within it the acquisition of the Citi credit cards book as well. So obviously, that's not going to repeat itself next year, but we are seeing very healthy growth on the credit card outstanding as well. The other part I did want to call out is that with the acquisition of the Citi portfolio, while we are seeing very good growth, we've also seen the acquisition of the industry's most mature and stable book to add it to what is the industry's fastest growing book. So when you put the two together, it actually gives us a very good picture in terms of the way the credit performance of the combined book with the two coming together will play out in the years and months to come.
And your operating expenses has also gone up by 34%. This is also due to acquisition, and also cost of funds at 5.17%, which is constantly increasing quarter by quarter. Can you give guidance on that front as
well? Thank you for the question. Yes, your observation is right. Cost of funds have gone up by 14 basis points. But it's also important to understand that interest earning assets or yields on interest earning assets are up by an equivalent amount. So we've been able to offset cost of funds growth, which is also reflected in the fact that our sequential quarter margins are up by 1 basis points. So that should give you comfort that while we do continue to expect the base book to reprice, the marginal funding cost has stabilized, and the base book will continue to reprice over the next few quarters. On your question on OPEX, we continue to invest in the business. Most of our investments, if you look at the slide that we put out in the investor presentation, effectively sets out that 51% of the year-on-year cost growth is for our technology and growth-related businesses. Please do appreciate that we do, on a year-on-year basis, incur the integration expenses that are likely to fall away. Those are the two key constituents for the growth that we are seeing, apart from business as usual growth on OPEX that one would expect for a business our size.
Thank you so much.
Thank you. Next question is from the line of Ira Duggal from Reuters. Please go ahead.
Hi. Looking at the point of personal loans. So you're not even wanting or seeing the need to pull back on sort of the flow, the growth and flow of personal loans that you're giving out. There's no sign of risk in your book at all, or rising risk in your book at all, is it?
Well, we have made that statement quite clearly that we are planning to grow and we continue to grow based on the risk guardrails we set for ourselves. So this growth is not coming at the cost of in any way compromising on what we believe is the right kind of risk to take. Right now, in our portfolio, we are not seeing anything which is telling us that our risk framework is not working. And as long as, obviously we are monitoring what is happening in the economy, we are monitoring where some of the stresses are building up, and we're watching it very, very closely. And you can expect us to do that going forward in the future. So whatever we grow and whatever pace we grow at, it is all based on certain risk guardrails, certain outlook and understanding of risk which we have as a bank, and we'll keep that in mind as we grow. But as Sumit pointed out in an answer to earlier question, that we do see growth momentum continuing at this point in time.
So delinquencies haven't increased or overdues haven't increased in your personal loan book?
You can look at our numbers and it's there in the presentation. If you want, I can give you the slide number and you will see that our metrics are trending in the right direction. I'll give you the slide number. You have it.
No, I don't have to do that.
Yeah, we'll just tell you that.
That's good enough. Thank you.
If you look at slide 60 of our presentation, you would see that our gross slippages number is declining period on period, and effectively our gross and net NPAs on the retail business are well contained.
Okay, thank you.
Just to supplement that, when we speak to credit bureaus and benchmark, we don't see any change, but we do observe there is a higher delinquency in sub 50,000 personal loan segment now. That is a segment we've chosen to stay away from. I think that is kind of clouding a lot of assessment about this business. And that's one segment we choose to stay away from.
Okay, thank you.
Thank you. Next question is from the line of Ritu Singh from CNBC TV 18. Please go ahead.
Hi, just to take forward that question on unsecured personal loans, one, if you could clarify your strategy from the sub 50,000 loan segment, why you're choosing to stay away. Secondly, while your portfolio you're saying is the growth is based on risk guardrails. In the SMA 1 bucket or so, with some of the other banks have indicated, are you seeing any, initial signs of stress? And we're asking because, the RBI governor himself has been talking about this, persistently, publicly. So is there anything on the personal loan front that you'd like to highlight? Any trends? Secondly, in your slippages, fresh slippages of 3,200 crore rupees, there's no breakup provided on corporate and retail, if you could give that as well. And thirdly, on your margins, which have actually grown by, say, or have been flattish quarter on quarter, are you confident, you'd be able to protect these levels or grow from here, given the, the liability repricing that is underway? If you could just provide your feedback on these.
So Ritu, on the portfolio quality, and I think you were asking the question in reference to RBI governor expressing concern on the rate of growth on the personal loan side. As I said, we are fully cognizant of all the risks that are there in the system, which are visible, not visible, which are being speculated about, and we are very conscious of some of these emerging risks. I think, as Sumit pointed out, we are not in the 50,000 and below category for personal loans. Our average personal loans are of much higher size. Please understand that the larger banks play on the lower end of the risk curve as far as personal loans are concerned. That does not mean that there is no risk. There is risk. We are watching it very closely, and we will continue to watch it closely. I mean, growth cannot come at the cost of, higher credit costs. So we obviously will watch as we move forward. Based on what we see today, as I said, we see growth momentum being sustained. Let me ask Puneet to answer the question on the NIM side. You asked the question whether NIMs can be sustained at this level. And
if I may, before that, if I may follow up on this, you said there is risk and you're watching it closely. Keeping that in mind, what are your plans for the remaining part of the year as far as growth in this portfolio is concerned?
I mean, we don't give guidance for specific product categories, or even we have always maintained a guidance that will grow at 400 to 600 basis points higher than industry average. That's what we'll maintain. I think we're saying a lot when we're saying we expect the growth to maintain growth momentum. Yes.
If you see slide 22 on personal loan, 83% of personal loans are to existing to bank customers. And these are set of customers whom we know well. We have their saving account with us, so transaction data, etc., risk qualification. We have superior knowledge of this customer set, and that's the bulk of our sourcing engine. Thanks.
Sure. On margins and the slippages as well.
Yeah, thank you for the question. I think what we've clearly called out is we don't offer guidance on margin, but our commentary on margins has been consistent from the start of the year. One request we have is please look at margins on a full year basis. Last year we delivered a 4.02 net interest margin with an 18% ROE. For H1 we are at a 4.11 margin with an 18.3% ROE. Given where we are, we feel comfortable that we should be able to protect margins at or better than our structural guidance on a go-forward basis.
Sure, thank you. On the slippages bit as well, if you could provide us insight into where it's coming from. That breakup isn't in the slide. the 31 odd crores of fresh slippages?
So if you look at our net slippages have declined 25% quarter on quarter. Our net slippages for the quarter is 1,269 crores, of which retail is 1,400 crores, corporate bank, which is our wholesale banking segment, is negative 220 crores, and our SME business, which we call as our commercial banking business, is 84 crores positive.
Sorry, may I just ask you to repeat the number? 1,900 crores?
Our net slippages on a rupee crore basis is 1,269 crores, of which retail is 1,405 crores. Our SME business, which is our CBG business, is 84 crores, and our wholesale business is a negative 220 crores. So when you add 1,405 plus 84 minus 220, you will get to the 1,269. On a sequential quarter basis, our net slippages are down 25%.
Thank you.
Thank you. Next question is from the line of Hamsini Karthik from the Hindu Business Line. Please go ahead.
Hi. So I just have a couple of questions. One is on the digital banking front. This quarter, there's been a net loss at a segmental level of about 29 lakhs. Last quarter was very strong at about 1.68 crores. I just want to understand how these numbers get calculated and how internally you bifurcate a retail business as retail and digital banking retail.
Thank you for the question. Let me clarify. At Axis Bank, our digital business is digitally sourced, digitally serviced. So end-to-end digital is what we call our digital business. We report that digital business as part of our publications, and that business has trended well both on a year-on-year basis as well as a sequential quarter basis. The disclosure that you're referring to is a regulatory description of digital, which is prescribed by RBI. It includes transactions like ATM transactions, cards transactions, so on and so forth. It is not digital as we understand it, and therefore my request is that disclosure is for compliance purposes. If you want to see the progress of our digital business, please reference our investor presentation. We are clearly confirming that we are seeing strong growth both in volumes, revenues, and profits coming from our end-to-end digital business.
Perfect. The other question is with respect to the share of loans to financial companies. That's at around 11% this quarter, everything included, advances, non-fund based, everything included. Would you, now that we know that there is risk in the less than 50,000 category, are you also looking into some of your client NBFCs to scan for risk? Because ultimately these are cash flow funded loans for any bank, and a risk of default there would also be a subsequent risk of default to the bank.
It's a fair point. I think the way that we look at our portfolios is by and large we lend only to the large NBFCs, very strongly rated, typically part of a large either financial institution or a large group, and so therefore we draw significant comfort from the fact that the balance sheet is well capitalized. We also understand that the business model has been tested through cycles, so the contagion effect that you're talking about is not something that we are concerned at this point in time. But we continue to watch the portfolio on the NBFC side.
Thank you. Just one last question here, sir. The September numbers for card spends doesn't seem to present a very healthy picture. There has been a dip in spends and there has been a dip in card issuances as well. Is it something which is, and this is for the entire sector, is it something which is seasonal or was the base effect of last calendar 22 very high, which is somewhere sort of offsetting on reality today?
Yeah, no, that's a good observation. The numbers for September, which were just published by the RBI, are around 1.42 lakh crores, down from the 1.48 lakh crores in the previous month. Yes, you're right. This is partially seasonal. Also, it has to do with the fact that September is a slightly shorter month, so there are multiple set of factors going into that. Okay. What we have seen is also that people tend to hold on to some of their spending because they anticipate some of these big events, some of which we have seen from our e-commerce partners and from many other retail players. And bearing that out, the spend that we've seen in October is actually much higher than what we saw in October last year. So you're right, some of this is seasonal, some of this is related to customers being smart about how they plan their festive spending. Also keep in mind that the big festive event is a little later this year as it was compared to last year, 3 to 4 weeks later. So all of these are factors playing out, and we're almost at the end of October, and what we're seeing is quite good.
Thank you so much. That helps.
Thank you very much. Next question is from the line of Shilpi Sinha from Economics Times. Please go ahead.
Hi. So I have two questions. One is on the deposit front. The total deposit, if I see on a quarter-on-quarter basis, has grown 1%. This, if I see other banks, they have grown 4 to 5%. If you can actually, just explain this part a bit, if there's a slowdown and what is the bank doing about it. The other one is on the Axis Bank share going up in Max Life Insurance. There, I understand around 65% of sales for Max comes from Axis Bank. Is that going to go up with the stake increase, and what is the status on the increase in stake?
Thanks for the question on deposits. This is Ravi. Yes, liquidity for us is very, very critical. The entire bank is focused on garnering deposits and pushing across not just the liability side of the teams, but every team in the bank is looking at seeing how they can get their relationships to deliver deposits. There are 3 or 4 large projects that are in play. We recognize that there is a lot of work that we have to do and efforts that we have to put. What we are looking at is trying to understand how we can capture at 2-3 levels. One, at a district by district level where we are in terms of our market share as a bank across all banks in that district. Second is in terms of white spaces that we want to cover across geographies and states. Third is in terms of how do we sweat the franchise branch by branch and see that a consolidation of all these efforts that we are doing based on catchments, micro markets, segments, the efforts are brought in. And as I said, to conclude, that the entire bank is working on getting and garnering deposits from every relationship that is there. Thank you.
Shilpi, I would like to add that we have the best-in-class CASA ratio. Please understand that when you're quoting the deposit numbers, you're looking at the overall deposits. From our perspective, the way we look at it is that we had a certain amount of asset growth. It could be funded through various means. We have best-in-class LCR outflow ratios now. So kind of if you look at all the variables, we believe that, if you just look at quarter on quarter, you might, please do not reach the conclusion that our deposit franchise is not doing well. We have various choices. We made those choices. And based on those choices, we could support a certain growth. And it is translated into some numbers. As far as Max is concerned, we have maintained that we would like to keep the share of Max in the 65 to 70% range. And that is the stated policy. Yes, we are planning to increase our stake. That process is underway as we speak. But having some competition, and it is firstly have competition, secondly give choices to our customers is an important element of our strategy as far as our customers are concerned. So that will continue as we move forward.
Okay. Any status report on the deal? Has it been approved by the regulator? Or?
Whenever we have anything to report to you, we'll be the first ones to let you know. Nothing more to report.
Thank you. Next question is from the line of Shan Ghosh from Live Mint. Please go ahead.
Hi. So, question on personal loan as well. There was an analyst report last month which cited a meeting of Axis with investors in Singapore and saying that apart from the less than 50,000 rupee bracket personal loans, there's also some stress on the higher end personal loans. I wanted to understand, is there a similar strategy at play there that you would like to avoid that? That's one. And second is, could you explain why the provisions went up in this quarter? Thank you.
So I think if you're referring to that particular report, it was, I think, referring to commentary made by someone else. We have not said that we are seeing any deterioration in our portfolio for some personal loans made above 8 lakh rupees. I think that was the number which was quoted. Very happy to get it clarified separately to you if that's what you want.
Okay.
I don't think we have made the statement that we are seeing anything in our portfolio which is causing some worry to us.
Okay, because this sort of quotes you, so I thought we would check.
Thank you. I'll address the second part of your question. Request you to look at slide 62 of our investor presentation. On a sequential quarter basis, our total provisions and contingencies actually have fallen. So we had provisions and contingencies in Q1 FY24 of 1,035 crores. They are down to 815 crores for Q2 FY24, please.
Sorry, this is on slide number?
Number 62 of our presentation, please. The table at the bottom.
And, just to clarify, I think it was not quoting Axis. What it was quoting me was what we're seeing as something which is developing in the industry. Nothing specific to Axis.
Okay.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, due to paucity of time, I request all the participants to restrict to one question per participant. Next question is from the line of Sachin Kumar from Financial Express. Please go ahead.
Yeah. Hello. Hi.
Go ahead.
My question has already answered.
Thank you. Next question is from the line of Vishwanath Nair from BQ Prime. Please go ahead.
Hi, good evening. Couple of questions. I'm sorry, I'm not meeting this one question limit. The first one is on the credit card portfolio. You said it's the highest growing, yes, in terms of issuances, but in terms of your outstanding loans on a quarter-on-quarter basis, it's up about 3%, and it was 10% in the June quarter. So I'm just trying to understand what has happened there, because that's the outstanding number and not the current flow that happens. And the second question, sorry, bringing up the personal loan segment again, it's at about 20% of your retail portfolio, just the credit card and the personal loans put together. Do you consider that high in terms of the constitution of the book?
So I'll answer the question on the credit cards portfolio first, and then hand over for the other one. The reference to fastest growing is to the gentleman who asked the question at that point of time, that the growth was 72%. In terms of market balance sheet outstanding, from our estimates, it is the highest growing, both in terms of issuances and in terms of the outstanding. A part of that obviously comes from the acquisition of the Citi portfolio, as I mentioned. But not all of it. Even without that, the growth is quite healthy. It is in the upwards of 25 to 30% range, if you look at the book without that. So we continue to see that growing. And as we continue to, we just mentioned that we acquired 1.2 million cards in the quarter, and this is the 7th quarter where we've done more than 1 million cards of acquisition. So as we get the tailwinds of that growing acquisition number, the outstanding will also continue to grow on the book, because we see that followed by healthy spending and by healthy lending as well. On the personal loans, Puneet.
Thank you for your question. I think the point that you were raising is, are we comfortable with the 12% proportionality for PL and 7% for cards?
Yeah.
I think the way I would request you to think about that number is, our retail book is 58% of our total book. So 19% of the retail book translates to about only 11% of our cumulative book. So that's not a large number. Again, if you evaluate the fact that not all cards outstanding is loan-based, because these are point-in-time balances as pointed out earlier. So there are transactors in this balance. So just for illustration, if you assume that half the book is transacting and half the book is revolving, this number on an overall loan book falls to sub 10%, it's roughly 9%. So just contextualizing this, this is amongst the smallest in the industry that we see. And yes, we are comfortable with the proportionality of this book in our overall loan set.
If I can just add one more point to the point that Puneet was making. If you look at slide 16, the RWA intensity of the overall portfolio is not really changing. So it is not as if the portfolio, the Axis Bank balance sheet is taking on more risk to deliver whatever we are delivering. The RWA intensity has been quite stable at 66 or 67% over the last few quarters.
Thank you.
Revolver basis.
Sorry to interrupt you. I'll request you to come back in the question queue.
There is no question, you guys.
Thank you. Next question is from the line of Anshika Katsia from the Hindu Business Line. Please go ahead.
Hi, sir. So you mentioned that you've been able to offset some of the rise in cost of funds via higher yields. I'm sorry if I missed it, but could you quantify the rise in yield on assets vis-a-vis the rise in cost of funds, and how much more of an increase are you factoring in for cost of deposits?
So our cost of funds for the quarter went up by 14 basis points. Our yield on interest earning assets also went up by 14 basis points for the quarter, so there is a full offset. You will also see the waterfall on slide 11 of our investor presentation, which will give you the breakdown. On our outlook on cost of funds, the way we are looking at cost of funds is the marginal cost of funds have stabilized. The back book of deposits will continue to reprice. The reprice is likely to take place over the next few quarters. Having said that, we have multiple structural levers in our NIM journey to optimize our NIMs, which is book mix, product mix, currency mix, so on and so forth. So we feel comfortable with where we are on our cost of funds and yields on interest earning assets journey.
Sure. Thank you.
Thank you. Next question is from the line of Lalatendu Mishra from the Hindu. Please go ahead. Mr. Mishra, may I request you to unmute your line and go ahead with the question, please?
Can you hear me?
Yes, we can now.
The net profit for the quarter has gone up by 10% to 5864 crore. Is it good or why is this? Second question is the net slippages you said about 1269 crore for this quarter. What was the year ago period number? Thank you.
So we've actually delivered a PAT that is better than the consensus estimates that analysts have. So I presume, given that we've beaten consensus, it's a good outcome to have for the quarter. To your second question on what was the equivalent value of net slippages a year ago, it was roughly about 1,000 crores for retail against the 1,405 crores for retail that I spoke about earlier.
No, 1269 is this quarter. What was the year ago period number?
So you want it on a cumulative basis? On a cumulative basis, it was about 600 crores.
Okay. Thank you so much.
Thank you. Next question is from the line of Amol from ET BFSI. Please go ahead.
Hi, thank you so much, but my questions have already been answered. Thank you. I will give it a pass.
Thank you very much. A reminder to all the participants, you may press star and 1 to ask a question. As there are no further questions, I will now hand the conference over to Mr. Puneet Sharma for closing comments.
Thank you, Nirav. Thank you, ladies and gentlemen, for taking the time this evening for attending this call. and patiently hearing our responses. If there are any unanswered questions, our communications team and our investor relations team would be happy to engage with you. Thank you and have a good evening.
Thank you very much. On behalf of Axis Bank, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.